Alright, what's up guys? Scott here again with a new live trading video. Today is Wednesday, July 6th, and for this one here, I'll be showing you guys some actual demonstrations of both the effectiveness and power of rolling your option contracts again and again and again to eventually make some nice profits, and then also the downside or the disadvantages of doing that as well. So basically here in this video, I'll be going over two different experimental trades that I have on right now in my paper money account, one of which is a short strangle on SPY, and the other is a wheel strategy position on AA, which is Alcoa. And so as you're going to see here, for both of these trades, I have been repeatedly rolling them out again and again to further and further expiration cycles to accomplish a few things. Number one here, to of course collect additional credit with each roll. Secondly, to reduce my risk by possibly changing my strikes when I do make that roll. And then also, of course, to extend the trade duration. And so ultimately with my SPY Strangle, I'm going to be taking that one off today for a very nice profit. But for my Alcoa position, as you're going to see, this one is continuing to get worse and worse and worse. Now, as always though, before we dive in here, in case any of you would like to join a very exclusive online community where you guys can really learn how to successfully trade options, then you can now join my options trading Discord. And once you join, you'll gain access to the following great benefits. Number one here, you'll see detailed real-time trading updates from my personal live trading account. You'll get daily trade suggestions and ideas, alerts regarding important market news, events, and price levels. You will also get very fast and personalized responses to any and all of your questions. And lastly, of course, you'll be able to participate in very engaging discussion with other like-minded traders and investors, myself included. And so if that sounds good to you, then be sure to sign up today using the link that you'll find in the description of this video, and you'll begin your 7-day free trial. And then secondly here, for any of you who are brand new to the channel, again, my name is Scott, and you can also find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And you'll also find some links to a few of my introductory courses in the description of this video below. So be sure to check them out, and when you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. And then lastly here guys, be sure to watch until the end of the video because at that point, I've got a very cool limited time opportunity for you all where you can receive up to 10 free stocks, and each stock could be worth up to $2,500. Alright guys, so now diving in here, and first off, we'll take a look at my SPY position, which is an ETF that tracks the S&P 500. So again, for this trade here, my position is a short strangle, which is a combination of selling both an out-of-the-money call option and also an out-of-the-money put option at the same time. And so specifically, if we come over to the trade tab here and take a look at the option chain, and also for this trade, as you can see here, I'm in the July 15th monthly expiration cycle with now only 9 days left to go. And right here is the current state of my trade. So I'm currently short the 389 strike call option as well as the 385 strike put option. So at the moment, this is a very narrow short strangle. And that's because this here is the result of making many adjustments to this trade. And so essentially for this strangle here, I initially put on the trade all the way back in April of this year. And because this trade was never profitable by the expiration date, or I should say close to the expiration date, I always had to roll it out to the next expiration cycle. And like I explained earlier, the point of doing that was to mostly collect additional credit with each roll. So that way eventually I could collect more and more money to eventually offset losses if I eventually wanted to simply exit the trade, or as you're going to see now in this video, finally take some profits. But also with each roll that I was making, I was also changing my strikes as well to keep my risk or my deltas on the trade in check at the same time. And then also on top of all that as well, sometimes during each expiration cycle, I would also have to make adjustments to keep my risk in check as well. And those adjustments would come in the form of either rolling down my call options or rolling up my put options to once again collect additional credit and most importantly, keep my deltas on the trade in alignment. Which basically just means I was trying to keep my losses from accelerating or trying to slow them down, right? Because with a short strangle trade or with any position where you're selling naked options, if the trade starts to move against you, your losses will start to increase at a faster and faster rate. Right, so again, by rolling down my call option or rolling up my put option during the actual duration of the trade, that serves to achieve this purpose of slowing down my losses if things start to get out of control. And so ultimately here, that's how I got to this current position of having a very narrow short strangle because again, I've had to make many adjustments to this trade. And so now though, what would happen if I tried to buy back both of these contracts right now and simply exit the trade? Well, first off here, let's go ahead and create the actual buying order, the closing order, so we can see the actual debit that must be paid to actually exit the position. So I'll go ahead and right click on my call option here and go to buy and strangle. And here we go. This is the closing order to buy back one contract of the 389 strike call option alongside one contract of the 385 strike put option. And so as you can see here, the total debit that I must pay to close this trade and buy back these contracts is $1,100 and about $60. So this here might seem like a pretty hefty debit to pay, but if I go ahead and pull up the calculator real quick here, and again, so the debit that must be paid here is around $1,100 and now about $70. Make that a negative number. But now if I add to this my total collected credit on this trade so far at this point, after many months of rolling and adjustments, my total credit on this trade is actually $1,902. So therefore the difference here is $732. This is actually my profit. And so at this point in the trade, this is definitely a satisfactory profit for me. So therefore I am going to go ahead and exit the trade. So now I'll come down here back to my buying order, and looks like the price has dropped a little bit as well. We'll try and lock in a price of maybe $11.62. Try and get filled immediately here. We'll go to confirm and send. And there we go, just got filled and price improved to $11.59. Awesome. And so there you have it. That example there was a good demonstration of the power and effectiveness of repeatedly rolling your contracts again and again, collecting more and more credit to eventually make some profits in the end. And also, if you do want to take a deeper dive into those adjustments I was just talking about by moving the call or put strikes during the actual expiration cycle, then I do have a separate video on that topic, which I'll post a card above linking to it, and you can watch it later. But essentially, all those adjustments, as well as the concept of rolling as well, fall under the category of delta hedging. And again, that's what that separate video I have is about. Now on the flip side though, rolling your trades like this does not always work this well. And in fact, sometimes you might be rolling for many months, if not years, and still never actually make a profit. So for example, if we come back to the charts and then go to AA, which again is Alcoa Corporation, this company here is mostly involved in the production of aluminum. And as you can see recently, this stock has undergone a massive sell-off. And so currently for my trade on this stock, I have some short put options as part of the wheel strategy, but I've had to continually roll those puts again and again because this stock just keeps on going lower. And initially, I sold those put options right around this point when Alcoa was back at around $70 per share. But obviously, as you can see, fast forwarding to the present, now the stock is down to only $40 per share. Now, of course, this stock cannot keep going lower forever, right? At some point, the worst case is Alcoa hits a price of $0 per share, can't go negative, but I still have a very long way to go to make back all my losses on this trade here. And even though I've rolled my puts several times at this point and I have collected some good additional credit, again, I still have miles and miles to go to even get back to where I started. So currently, if we go to the trade tab real quick here and take a look at my position, and for this one as well, I'm in the July monthly cycle with only 9 days left to go. And as you can see over here on the put side, my contracts are way down here at the 75 strike. So these puts are super far in the money, and I'm definitely running the risk of an early assignment unless I roll these contracts again to the next cycle, which I'll do right now. But the main issue here, as you're going to see when I try and do this, is that I will not be able to roll these contracts for hardly any additional premium or credit at all. So even though theoretically speaking, if you do roll your contracts forever, at some point you will collect enough credit to make back your losses. But again, you could be doing this for many years because in this case, when your contracts are so far in the money, you're going to collect a very small amount of additional premium. However, if my contracts here were only a little bit in the money or perhaps kind of right at the money, then I could, in those cases, roll my contracts for a lot more in additional premiums. So just keep those situations in mind if you're using this kind of defense or management technique. So now we'll go over to the monitor tab and find my current Alcoa position. There it is right here. And thank God this is a paper money account because as you can see over here on this one trade, I'm down by $5,600. That's a lot of money. So now coming back over here and right clicking on the position, and then go to create rolling order and sell 2 calendar spreads here. And then as you can see here, this is one order that's going to accomplish 2 things. Number 1, it's going to buy back my 2 existing 75 strike put options in the July cycle. And then at the same time, it's going to sell 2 more contracts currently with the same strike in a further dated expiration cycle. So I'll change this to the August cycle, which is August 19th. So there we go. Now this one order is going to accomplish me rolling out my contracts to the next cycle. But the issue, as I said, is look at the additional credit I'm going to collect for doing this. It's only $10 per contract. And again, with me being down by over 5,000 bucks on this trade here, if Alcoa simply stays around this price for a very long time, I'm never going to make back these losses. So at this point, your 2 choices are basically either take assignment by expiration day, or what I'm going to do here is once again, roll my contracts out to the August cycle. And that's because I am still hopeful that Alcoa here will recover at least a little bit at some point, and therefore I'll be able to continue rolling my put options for more and more credit. So basically right now with this current roll, all I'm accomplishing here is simply extending my duration on the trade, right? Because collecting 10 additional bucks per contract is basically nothing. And now actually, as you can see, the mid price for this roll has dropped to now only $5 per contract. And we'll see if I can even get filled at this price. So I'll try and lock in this $5 price tag here, go to confirm and send the order. And no fills yet on this trade, so we'll come back to the monitor tab and perhaps lower my price even more. So there's my Alcoa order. I'll right click and go to cancel and replace. And we'll try and come down to just $1 single per contract. Confirm and send. And still no fills yet on this order here. So this definitely highlights my point that rolling again and again does not always work, right? Once more, if your contracts go too far in the money, which is the case for Alcoa here, not only will you not be able to roll for hardly any credit at all, you simply may not even get your orders filled because very few contracts that are this far in the money are even traded, right? For example, as you can see here with these 75 strike put options in July, and taking a look at the daily volume so far, only 1 of these contracts have been traded today. And so at this point, I'll just keep this order open for the rest of the day, and hopefully someone comes along and fills my order here. But if I can't get filled at all, either today or by the expiration date, then at that point, I'll have no choice but to take assignment and simply own 200 shares of Alcoa. And also, given that my delta on these puts is already 100, that means these put options here are already trading exactly like 200 shares of stock anyway. So whether I roll these contracts to August or I take assignment, then in either case, my risk on the trade stays exactly the same. So ultimately here, guys, if you are going to use this rolling approach, which still is a great method to defend and manage trades, just make sure you use it on stocks you don't mind potentially owning in these kinds of situations, right? So Alcoa here is a pretty quality and profitable company, again, involved in the production of aluminum, which in general I'm bullish on given the inflationary environment that we're in right now. So ultimately, I would not mind owning shares of this stock anyway. But if we're talking about a stock like GameStop or AMC, then I would definitely not use this approach at all because I definitely would not want to own shares of any of those stocks. And so that's going to do it here for this video. But one last thing to mention, as I talked about at the beginning of the video, I've got a very cool limited time opportunity for you all where you can receive up to 10 free stocks. So basically, there is a newer brokerage company out there called Moomoo, which is based in Palo Alto, California. And again, for a limited time, they're offering you the opportunity to receive up to 10 free stocks when you sign up for a brokerage account with them using my link in the description of this video. And so the Moomoo trading platform is highly competitive with other comparable platforms like Webull and Robinhood. There are absolutely no trading fees on stock or option trades. You also get direct trading access to US, Hong Kong, and Chinese markets, which is something I have not seen being offered by competing platforms. Moomoo also comes with a free, very advanced yet totally user-friendly trading platform that you can install on your computer or your smartphone. And of course, everything is regulated by the SEC and FINRA, so your trades and your investments are properly insured. And so if that sounds good to you, then again, use my link to sign up in the description of this video and get your free stocks. And also don't forget to check out and sign up for my options trading Discord as well as my Skillshare courses. Links also in the description of this video. And finally here, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.